If you are a salaried employee and you pay income tax, then I will tell you how you can pay less tax. If you are an employee, then it may possible that you know already about this all method, but in case you don't, then it's very important that you should. And if you plan on working in your future, then you should definitely know about them. The Section 80C of our Income Tax Act 1961 inform us about the places where you can invest to pay less tax. It is known as deduction. If you invest in these places, you can get a deductions from your income so that you don't have to pay tax on that amount. So basically you are saving on your income. Section 80C says that if you invest a total of 1.5 lakhs rupees in specific things, then you won't have to pay tax on that amount. So I'm going to tell you about those specific things, and will also tell you about the most popular and the safest option among this. So first is PF account, Provident Fund. PF is helping to create a goal with long-term returns. Deposits made in PF are eligible to claim a tax deductions up to 1,50,000 under the Section 80C. In PF account, there are two types: EPF, Employee Provident Fund, and other and Public Provident Fund. So first option is EPF, Employee Provident Fund. It is one of the older and popular scheme introduced by the government. You can apply for an EPF if you get a salary, whether you are an employee somewhere or self-employed. As per the scheme, 12% of the salary that you draw is invested in EPF, while you're the employee invested an additional 12% on your behalf. So in this total, 24% of your salary goes into the EPF. Of the 12% that you pay, you don't have to pay tax 1.5 lakhs rupees in per year. And the amount that your employee pay on your behalf, you don't have to pay tax on any of it. So you save lot of your income tax if you invested your salary in EPF. Once you invested in EPF, you earn an interest of around 8.5% of your saving. That exact interest rate is deducted by the government every year and may fluctuate a little, but financial year 2020 and 2021 it was 8.5. So question is, when can you withdraw the money from EPF? Generally, there is a lock-in period for 5 years, which means you cannot withdraw the money before 5 years. Even after 5 years, there are few conditions limiting the amount of the money you can withdraw according to the reason for withdrawal. For example, if you need money for your child education or marriage, then you can take withdrawal the money from your EPF account. But generally, this policy was made by the government to provide for you after your retirement. When you stop working, you can withdraw your money from EPF. That was the purpose for which it was created and named after Employee Provident Fund. While you are an employee, you invest in Employee Provident Scheme, and when you retire and stop drawing salary, you can use this fund. Investing in EPF is very simple. You simply go to your employer and ask them to register you for an EPF. If they haven't already, once that is done, ask for the UN number. After which, download the Umang app. This app was introduced by the government. It shows the monthly balance of your EPF account and the interest earned. If you are a salaried person, this is the good option for your saving, and you should definitely go for it. Next option is PPF, Public Provident Fund. Similar to EPF, another amazing scheme by the government for the income tax is PPF, Public Provident Fund. This is the applicable for the everyone, and it is very simple. Basically, you invest 1.5 lakhs rupees in a year per person, and you get a return at 7.1% interest rate. The government decides its exact return rate every year. Like EPF, the interest rate will be applicable for 31st March 2022. You can start a PPF account for every person in the family, even if you have a kids of less than 18 years old, and you invest 1.5 lakhs per year in the PPF account on their behalf. For example, if you invest 1.5 every year for 15 years and the interest rate remains 7.1%, after the 15 years of your investment amount 22.5 lakhs rupees, but you get a return of 40 lakhs 68,000 rupees. So you can see the huge difference between 22.5 lakhs and approx 41 lakhs, 19 lakhs gap between two. So I will recommend that you should definitely go for PPF. The best thing is that the approx 41 lakhs that you withdraw, you do not have to pay any tax. But if you had invest the same amount in some other places like the fixed deposit or stock market, you would have had to pay tax on the return. That is the difference. It is very easy to register for PPF. You can go any post office or designated bank to register for the PPF. There is no set of rules about how you have to invest a PPF, but you can deposit a certain sum monthly or yearly. The lock-in period for PPF is 15 years. It is a long-term investment. If you want to withdraw the full amount from the PPF account, then you can do only after 15 years, or you can make partial withdrawals before the 15 years, but only after the maturity period. Another major advantage of EPF and PPF is that they are the government scheme. and the safest options to invest because of zero risk. The market may fluctuate, but your money will be safe. The return in the stock market or any other place are unpredictable, but here the return is fixed and risk is zero. The third method of investment in the tax savings scheme is ELSS, Equity Linked Savings Scheme. ELSS is a type of mutual fund. It is also covered under Section 80C. If you invest money in this, 1.5 lakhs rupees of the investment per year will be assumed for the tax, but it is linked with the market, so the return will fluctuate with the market. In the past 5 years, most of ELSS funds are given return of 15 to 20%. Potentially, it can give return much higher or lower than EPF or PPF because it depends on the market. If you want to invest in ELSS, you can go through the asset management company or you can use the app. If you invest in ELSS, research about all those things. Always look the historical performance of all the mutual funds. That is the return rate of mutual fund in the last few years. However, you cannot predict the future of the market based on the historical performance, but you get an idea of what kind of returns to expect. For an example, assume that you invest 2 lakh rupees in ELSS which increased to 2.5 lakhs after 3 years. So you do not have to pay tax for 1.5 lakh of it, nor the interest rate that you earn in the 3 years. However, there is a new tax of 10% introduced in 2018, long-term capital gain tax. It will be applicable on the amount that you withdraw. In case it exceeds more than 1 lakh rupees, there will be no taxes other than this. The lock-in period for ELSS is 3 years. Fourth option for tax savings is life insurance, but the life insurance is not considered as an investment because you do not invest in life insurance for the returns. You invest life insurance for the security. If you invest in life insurance, it's also included under the Section 80C. You do not have paid tax on the 1.5 lakhs of your investment. Next is medical insurance premium. Section 80D of the Income Tax Act helps to claim a tax deductions from the total taxable income from the payment of medical insurance premium. Maximum deductions of 25,000 per year as you pay for the medical purpose for self, spouse or children. The maximum tax deduction limit for the senior citizens is 50,000. Also, if you have spent money on behalf of your parents, then you get a maximum tax deductions up to 25,000. The next is saving account. If you have kept your money in normal saving bank account and you get interest on it is around 2.7%, the interest rate that you get there is assumed for the till 10,000 rupees and deduction till 10,000 rupees interest rate from the saving account. This is defined in a Section 80 TTA. Next is fixed deposit. Any term deposit with a tenure of the 5 years with the scheduled bank also qualifies the deduction under the Section 80C and the interest earned on it is taxable. Next is 5-year post office time deposit scheme. POTDS are the similar to bank fixed deposit. They are available for the different time durations like 1, 2, 3 and 5 years, but only 5 years POTD qualifies the tax savings under the Section 80C. The interest rate on this compounded quarterly but paid annually. The interest rate is reviewed by the government every quarter. Currently, they are offering 6.7% a year as decided by the government for the December 2020 to March 2021 quarter. Please note that the interest earned it is entirely taxable. So the next scheme is Sukuna Samriddhi account. In this scheme, you can open an account on behalf of your daughter till the age of 10. Any amount deposited in this account would be eligible for deductions under Section 80C. Further, this account can be opened for a maximum of 2 girls, and in case of twins, this facility will be extended to the third child as well. There are the other conditions attached to the investment. The amount has to be deposited in this account for 15 years. The account will be mature after 21 years, which means that you do not have to deposit anything between 16th and 21st year. The minimum annual deposit has been reduced to 250 rupees, which can go up to 1,50,000. Interest rate on new deposit is subject to revisions every quarter. The quarter ending 31st March 2021 and the interest rate is 7.6%. So next scheme is National Savings Certificate NSC. NSC is a tax saving instrument with a maturity period of 5 years. A person can purchase NSC for as low as 100 rupees with no limits on the investment amount. Any investment in NSC are eligible for the deductions under the overall limit of Section 80C. This interest is compounded annually and it is taxable. However, the Bring calculative scheme, each year interest is considered reinvest in NSC. Since it is deemed reinvest, it qualifies for the fresh deductions under Section 80C, thereby making it effectively and tax-free. Only the final year interest when the NSC mature does not receive a tax deductions as it does not get reinvested, but it's pay back to the investor along with the interest of the previous year and the capital amount. The interest on new issue of this certifies it's received quarterly by the government. However, it is to be remembered that the interest earned every year except the last one can be claimed as a deduction from the taxable interest under the Section 80C, subject to the limit under these sections. This This is only if the deduction limit currently at 1.5 lakh rupees is not already fully used, then one can claim this interest as a deductions, thereby making it effectively tax-free. For the quarter ending 31st March 2021, NSE are offering 6.8% compounded annually but payable at maturity. So the next is Unit Linked Insurance Plan ULIP, and the insurance product which cover life insurance and also provide the benefits of equity investment. ULIP offer life coverage, tax saving, also help to grow your money over the long term. However, unlike PF or ELSS, higher charge associated with the investment is ULIP due to the life cover element. Also, there are the certain condition associated with the ULIP as it is a life insurance policy as compared to the other tax savers. Going forward, if the annual premium of your new ULIP's investment is more than 2.5 lakh, the return that you will get will no longer as be a tax assumption. Tax assumptions shall be available under the section 10D only for maturity proceed of the ULIPs having annual premium up to the 2.5 lakh. In case of ULIPs having annual premium more than 2.5 lakh, income or return on the maturity shall be treated as a capital gain or charge according to the other sections 112A. However, the cap of 2.5 lakh on the annual premium of ULIPs shall be applicable only for the policies taken on or after 1st Feb 2021. So the next plan is Senior Citizen Savings Scheme 2004 SCSS. This scheme, as the name suggests, it's meant only for the senior citizens. Any individual in the age of 60 or above age group, an individual above 55 but less than 60 and having retired under the voluntary retirement scheme or a special voluntary retirement scheme can also open an account under this scheme, but such as account must have been opened within the 3 months of the retirement date. If you are a retired defense personnel, there is a bad news for you. As per the new rules effective from 3rd October 2017, retired defense personnel can invest only if he is 50 years of age. Earlier, the retired defense personnel could invest in this scheme irrespective of age, provided they met other specific conditions. Any investment in this account would be eligible as deductions under Section 80C. The current annual rate 7.4%. There are few more options where you can pay less tax. Options are home loan EMIs, stamp duty and registration charges for homes, retirement saving plan, tuition fees paid for your children education qualifies for the income tax deductions under Section 80C, infrastructures bond, treatment of disabled dependents, deductions for preventive health checkups, interest paid on education loan, deduction on house rent paid. So these are the few most popular ways to save your tax, which is recommended by the government itself. If you want to know more about this method and the benefit applicable to salaried person, then visit the government website incometaxindia.government.in. You will get to know more about these benefits available to the salaried person here. My final suggestions would be to read up on the topic and research on them. Only when you understand these methods properly, take an action. So hope this video is helpful. My name is Santanu Pakhira. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Ta-da.